There's a siren song in the financial world, a constant hum of market trends that promises to guide us to calmer waters and greater riches. We see them everywhere, in headlines, in analyst reports, in the whispers of the crowd. They suggest a clear path, a predictable trajectory, a way to harness the market's momentum. But what if much of what we perceive as a trend is, in reality, a carefully crafted illusion? What if these apparent movements are designed not to guide us, but to distract, to pull us away from the deeper, more fundamental truths that actually underpin sustainable wealth? Benjamin Graham, the father of value investing, understood this profound deception. He cautioned us in the intelligent investor the stock investor who tries to outsmart the market is likely to find himself outsmarted. This isn't a defeatist's lament, it's a sober recognition of how easily we can be led astray by superficial narratives. The market, in its complexity, often presents a dazzling facade that obscures the quiet, persistent forces of intrinsic value and rational analysis. This is why we embark on a journey today, a journey to unmask these deceptive trends. We will dissect 5 common interpretations of market movements, interpretations that all too often lead astute investors onto rocky shores. Our aim is not to predict the unpredictable, but to cultivate a deeper, more critical understanding. We will reveal the data-driven strategies, the analytical frameworks that truly matter for building wealth that lasts, wealth that is not dependent on the whims of fleeting sentiment or the misreading of charts. Prepare yourself to question what you think you know about market predictability. It's time to move beyond the noise, to embrace a more robust, a more analytical approach to navigating the intricate financial landscapes that surround us. This is about sharpening your discernment, about finding your edge not in chasing shadows, but in understanding the substance. The first strategy we must decode is the momentum mirage. This is the seductive idea that a stock's recent surge guarantees future gains. It's the powerful urge to join the herd, believing its direction is inherently correct. Yet, the data reveals a different truth. Chasing momentum often means being led towards the cliffs. The statistical fallacy here is assuming past price action dictates future performance. We've seen momentum crash, where soaring stocks suddenly plummet, fueled by behavioral biases like FOMO and herd mentality. It's like a flock of birds assuming their current direction is their destiny. But a strong gust of wind, a market shock, or a fundamental shift, a predator, can cause a catastrophic, unpredictable change, leaving the flock ill-equipped to adapt. The saying "the trend is your friend" can be a dangerous oversimplification. Over-reliance on trend following often leads to buying at peaks and selling at troughs, the exact opposite of sound investing. Benjamin Graham taught us to seek value, not just follow price. So, how do we see through this mirage? Implement a trend validation framework. Before jumping on a trend, ask, is this movement supported by fundamental shifts in the underlying asset's value, or is it purely speculative? Indicators like RSI divergence and volume analysis can help confirm sustainability, not just direction. True trend decoding isn't about following the masses, but about understanding the underlying reasons for persistent market movements, often rooted in deeper economic or business cycles, not just price charts. It's about discerning substance from illusion. Our second strategy for decoding market trends involves recognizing the narrative trap. This is where compelling stories, often about disruptive technologies or the next big thing, override objective financial analysis. These narratives can inflate valuations to dizzying heights, completely disconnected from the intrinsic worth of a company. It's a powerful force, capable of obscuring even the most glaring financial weaknesses. Consider the dot-com bubble, a stark historical example. Investors were captivated by the narrative of a new economic paradigm. Traditional valuation metrics were dismissed as relics of the past. Companies with minimal revenue, let alone profits, were valued in the billions simply because they fit the prevailing story. When that narrative inevitably shifted, the valuations didn't just deflate, they collapsed, leaving many investors with significant losses. We must also be aware of the hidden incentives at play. Media outlets and even some analysts can amplify these captivating narratives, not necessarily out of malice, but for clicks, for fees, for the attention that hype generates. This creates a dangerous feedback loop, a chorus that masks underlying financial frailties. Forensic accounting red flags, such as aggressive revenue recognition or unsustainable debt levels, are often ignored in the fervor of a hype cycle. To guard against this trap, develop a narrative versus numbers checklist. For every exciting story you encounter, demand concrete financial data. Ask for the revenue growth, the profitability, the cash flow generation, the debt levels, and crucially, the strength of the company's competitive advantages, its economic moats. If the numbers simply do not support the compelling story being told, then skepticism is not only warranted, it is essential. The ultimate takeaway is this: a powerful story, while engaging, can be a siren's call, luring unsuspecting investors onto the treacherous rocks of overvaluation. Your strategy must be to anchor yourself to the solid ground background of fundamental analysis. Use the unwavering compass of data to navigate these potentially misleading narratives and find true value. Our third strategy to deconstruct is the economic indicator illusion. Widely cited economic data, inflation rates, GDP growth, unemployment figures are often misinterpreted. They are frequently used to justify pre-existing market biases rather than serving as true predictive tools. This creates a false sense of understanding, an illusion that we can reliably decode market trends through these numbers alone. Consider a doctor observing a patient with a fever and a rash. Both symptoms are present, but is the fever causing the rash, or are they separate manifestations of a deeper underlying infection? Treating only the rash without understanding the fever, the root cause, would be ineffective. Similarly, reacting to market movements based on a single observed indicator without grasping its causal relationship to fundamental economic forces is misleading. We see correlation, but mistake it for causation. Furthermore, we must grapple with the lag effect. Many economic indicators are inherently backward-looking. By the time they are officially reported and begin to influence market sentiment, the actual economic conditions they reflect may have already shifted significantly. This creates an illusion of being ahead of the curve, when in reality, we are merely reacting to past events. The market often has already priced in this information. To counter this illusion, focus on leading indicators and their intricate interrelationships. Instead of simply reacting to a headline inflation number, delve deeper. Analyze the actual drivers of that inflation. Are they supply chain constraints, shifts in consumer demand, or perhaps the effects of monetary policy? Understand how different indicators interact, how they influence one another, rather than treating them as isolated data points. The core principle here is profound. True market decoding requires understanding the intricate mechanics of economic cause and effect. It's not enough to merely observe correlated data points. Your strategy must be to build a robust, dynamic economic model in your mind, one that seeks to understand the underlying forces rather than simply following the often misleading headlines. It's about seeing the system, not just the symptoms. Our fourth strategy to decode involves the AI and algorithm aura. In today's financial landscape, there's an increasing reliance on artificial intelligence and algorithmic trading. Their sheer complexity can be dazzling, creating an aura that masks potential fundamental flaws or, more concerningly, new forms of systemic risk that are incredibly difficult for human investors to fully grasp. This brings us to the black box problem inherent in some AI systems. When algorithms become so intricate, even their creators may not fully understand why a particular decision is made. This opacity can hide embedded biases or faulty logic, leading to unpredictable and potentially damaging market behavior. The sophistication of the tool can thus obscure its own limitations. We must also acknowledge the overlooked risks associated with these advanced systems. We've witnessed flash crashes where markets plummet in minutes due to algorithmic reactions. There are algorithmic feedback loops where one trading program's action triggers another, creating a cascade. And the potential for system-wide failure when multiple algorithms react in a similar, unforeseen way to unexpected events is a very real concern. History has already shown us instances of such algorithmic malfunctions. Your actionable insight here is crucial. Do not be intimidated by the AI label. Instead, strive to understand the principles behind the strategy, not merely the technology itself. Focus on the underlying logic, the risk management protocols in place, and critically, the quality of the data feeding these algorithms. If a strategy is so complex that it cannot be explained simply, it may be too complex to trust with your capital. The critical realization is that technology, however advanced, is a tool. It is not a substitute for sound judgment, for critical thinking, or for the wisdom gained through experience. Your strategy must be to complement any algorithmic insights with your own fundamental oversight. This ensures that you, the investor, remain the master of your investments, not merely a passive observer of automated decisions. Our fifth and final strategy for decoding market trends is the contrarian's compass. This approach champions identifying value not by chasing popular trends, but by looking at assets that are temporarily out of favor. It's about finding quality when overblown fears or market sentiment push prices down, creating opportunities for those with the courage to look beyond the immediate noise. Picture a bustling marketplace. Most people are rushing towards a stall overflowing with brightly colored, trendy fruits, drawn by the immediate excitement. The contrarian investor, however, notices a different stall. There, you find perfectly ripe, highly nutritious fruits, perhaps less flashy, being sold at a deep discount simply because few people are paying attention. This investor acquires this undervalued, quality produce, understanding that its true worth will eventually be recognized by the market. Consider this symbolic provocation. The fear index can often serve as a powerful buy signal. When widespread panic grips the market, it frequently presents the greatest opportunities for disciplined investors. It is precisely during these moments of widespread selling, driven by the fear of missing out on the downside, that quality assets can be acquired at bargain prices, a stark contrast to the FOMO that drives trend followers. To effectively implement this, you must develop a robust framework for identifying undervalued assets. This requires rigorous fundamental analysis to determine intrinsic value, a deep understanding of the business itself and its competitive moat, and crucially, the psychological fortitude to act when others are fleeing. It demands patience and conviction. The ultimate truth revealed by the contrarian's compass is this: decoding market trends isn't about predicting the unpredictable future. It's about understanding human behavior, the cycles of fear and greed, and the underlying economic realities that govern value. The contrarian's compass points not where the crowd is rushing, but where true, enduring value lies, often in the opposite direction. We have journeyed together beyond the alluring whispers of superficial market trends to uncover the deeper, more persistent currents that truly shape financial landscapes. We've dissected the momentum mirage, the narrative trap, the economic indicator illusion, the AI and algorithm aura, and finally, embraced the contrarian's compass. Each of these strategies, when understood through a lens of critical skepticism and data-driven analysis, empowers you to see what truly matters. Remember the timeless wisdom of Warren Buffett: it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This profound insight extends beyond individual stock selection. It is the very essence of decoding market trends. Seek the substance, the intrinsic value, the enduring quality, rather than being swayed by fleeting appearances or the siren song of popular opinion. The market will always present its share of mirages, but your task is to discern the oasis of true value within. By diligently combining rigorous, data-driven analysis with a deep understanding of behavioral psychology, the very forces that often drive those deceptive trends, and a firm grasp of economic fundamentals, you can transform what often feels like market uncertainty into a landscape of opportunity. This is not about predicting the future with absolute certainty, a fool's errand, but about building a resilient framework that allows you to navigate volatility with confidence and clarity. Continue to question, continue to analyze, continue to seek the truth behind the headlines and the charts. Build your financial future not on the shifting sands of market illusions, but on the solid bedrock of informed decisions grounded in logic and objective reality. Your journey toward true financial mastery, toward sustainable wealth accumulation, is paved with this kind of discerning wisdom. The path is yours to forge.